And thank you so much for joining our follow-up session about the 2026 proxy season. I'm Gloria Cordes Larson, a Boston-based attorney and the former president of Bentley University. I've served on a number of public company boards, and I'm very excited to return today as the moderator. Many of you, I hope, attended the initial Hot Topics for the Upcoming Proxy Season program we held on January 21st. Not surprisingly, we had so much rich content to cover that we didn't cover all of it, nor were we able to get some of the really terrific questions that we found in chat. So today's conversation and this recording gives us a great opportunity to finish the discussion. So first of all, let me reintroduce very briefly, you have their bios, our panelists. Therese Lilly has served as CEO of CRL Consulting since retiring from Comcast in 2017. She's the former board chair of the Federal Reserve Bank of Philadelphia and a current director on public company boards. Kai Lakefet co-chairs Sidley's Public Company Advisory and Shareholder Activism and Corporate Defense Practice. He serves on the board of the New York chapter of NACD and was named one of America's top lawyers by Forbes for 2025. Connie Lynn is a principal at Pay Governance with over 15 years of experience working with public company compensation committees and senior management teams on a wide range of executive compensation issues. Thank all three of you so much for joining the second session. So Kai, you have the honor of the first question. We got a whole series of great questions, and this one I feel a little bit remiss about not covering in the first place. As you know, you and Therese, you were also part of the early conversation about the new engagement techniques, the onus that we've now placed, or the SEC has now placed on companies to connect with their top investors as well as others. So that discussion of engagement strategies, I was remiss in not asking the earlier question, which one of our great audience members suggested, which is, Kai, could you go back and explain a little bit about the SEC's expanded definition of active investor and the limits it does place on company engagement by large passive investors? So we'll start there.
Very, very good, Gloria. So let's do that. So as many of you may know, in the United States, the federal government, in its wisdom, decided to distinguish between two kinds of investors when it comes to ownership reporting. Once you cross the 5% threshold in a public company, you have a choice as an investor to either report your ownership of over 5% as a passive investor by filing a 13G. I like to think of this G as stands for the good guys, or you file a 13D, D for dangerous, when you are an active investor. Now, in the past, the distinction between D and G, dangerous or good, depended on your engagement with the company, meaning how are you actively trying to influence the company with your views. If you try to influence a board and policies, you have to file a D. If you are a passive investor, you have to file a G. Now, the index funds in particular, BlackRock, Vanguard, and State Street, they own thousands of positions in the US alone. And for them, this is actually not a trivial question whether to file a D or a G. Why? Because for the 13D filer, it's actually a really extensive, intense, detail-oriented disclosure document. Whereas for a 13G filer, it's a very simple, short document. And 13D filers are required to update their filing within 2 business days if something material changes. 13G filers have no such obligation. So as you can tell, there's a strong incentive for big, large institutional asset managers who own 5% or more in a company's stock to try to stay on the G side, because it lowers the legal risks, the compliance cost, and the administrative burden on a large asset manager. So why do I explain all of this? Because BlackRock, Vanguard, State Street, and a lot of other institutional investors have been engaging with companies for decades over numerous topics such as corporate governance, ESG, and the like, and trying to convince those companies to adopt what they perceive are best practices of corporate governance, what are their view on environmental, social, and other issues. And the SEC under the Trump administration 2.0 has been very focused on that. They take the position that, well, if you do that, if you tell companies to declassify the board, to give shareholders a right to call special meetings, to split the chairman or CEO roles, to focus on your sustainability disclosure, to treat your employees and directors equally, regardless of race, then you are actually an active investor, no longer eligible to use the straightforward, streamlined, short form 13G filing. You actually are a 13D filer. And this guidance, as we explained last time around, hit in the middle of the beginning of proxy season on February 11th. And in all fairness to the SEC, while this was clearly motivated by the Trump administration's dim views of ESG, D&I, and lots of other acronyms, it's not like this is an absurd position to take for the SEC when you actually look at the genesis of the rule distinction. And you can debate whether we need to have such a rule distinction to begin with. There are lots of civilized countries, including my home country, Germany, and most of Europe and half of Asia, who do not distinguish between active and passive investors. But since you Americans, in the wisdom of your ways, decided to have this bifurcated ownership reporting system, I mean, you got to be honest and truthful in what lane you choose, active or passive. And so when we talk to colleagues at the SEC, I mean, there is a widely held view that it was probably prompted by highly political considerations around ESG and D&I and the Trump administration not wanting large asset managers to tell companies what to do on these hot topic culture war issues. But there is a solid legal basis for the SEC to be stricter on this issue.
So Kai, that's really great. And let me just ask a couple of, or maybe just one follow-up question, which is, so talk a little bit about just briefly, the self-imposed limits, guardrails that the big three and others have now placed on themselves. This sort of listen-only approach, go silent in some cases, give disclaimers as soon as they get on a call with an investor with a company who's invited them to a meeting. It feels like there's this uniform response of, okay, we're going to vacate that engagement playbook completely, and there's a whole new one emerging. And I'm just wondering, is there some truth in the middle about what they might be able to do going forward?
Yeah, it's still developing. At the beginning, I mean, basically BlackRock, Vanguard, and State Street unplugged their phones, and then they start to re-engage after a week or two with very strict guardrails. As you mentioned, a disclaimer is typically read at the outset that we don't try to influence you in any form or fashion, even if we do. They are typically not providing an agenda. They're typically not asking questions. They are typically just sitting there and basically say, tell us what you want us to know, and we are not going to react to it, which is pretty unnerving for a lot of clients, by the way. Now, what we have found is that this has started to mellow a little bit over the course of the last 12 months. And in particular, in the off-season engagements, you get a little bit more feedback from institutional investors. And obviously, and it bears repeating because a lot of people forget that, if your counterparty, if your investor is under 5%, all of this goes under the window, right? They can ask you for the head of the CEO if they are under 5%. That doesn't matter. It's just only once they are over 5%. And that typically applies to BlackRock and Vanguard. It doesn't always apply to State Street. State Street is sometimes a large shareholder. Oftentimes they're under 5%. And obviously, this applies also to a lot of other institutional investors who are oftentimes just not over 5%. And sometimes you just need to remind them, hey, you are in the safe harbor zone. You can tell us whatever you want. You're far under 5%.
I think those follow-up comments are really helpful, so I appreciate that. And now I want to just turn really briefly, because it's such a good question, I don't want to leave it to the side, about some follow-up advice to small cap companies around how they engage. This onus now placed on the companies themselves. And this question really leaned into the idea of, look, how if they're a small cap, smaller company of any, sort of medium size too, how do you best work with your management team? How do boards best work with investor relations around engaging with active investors? So Charisse, you did a great job in our first conversation about talking about using the proxy, and that's one way. And Kai, you also offered some commentary on the ways that you can go down the list of your investors, solicit meetings, all those things. But I'm feeling like it's a really more difficult, by a mile hardship for these smaller companies now to figure out how do they engage with active investors in a productive way. So sort of a toss-up ball. Maybe start with you, Charisse.
Well, I think it's harder because they've got fewer resources and it's just going to be a challenge. And I think with the larger companies, you have the resources, you have greater opportunities. So I don't know that I really have any advice except, perhaps increasing those resources, but that costs money and then that takes away from your profits. So I'm not sure. So I'll be interested to see what Kai has to say
No,
about this.
that's a helpful start, because I'm
Yeah.
also wondering about sort of communication strategies,
Mm-hmm.
because more broadly, I mean, you did a great job talking about the proxy. That's clearly one.
Right.
But are there other things when you think of investor relations, maybe Kai, that you would point to?
I mean, there are a number of highly sophisticated, very cost-efficient investor relations / IR firms that can help small caps with this kind of engagement, knowing that and realizing that, as you pointed out, that a lot of these smaller companies just don't have the bandwidth to have sophisticated, comprehensive investor relations program. So I mean, just get one of these firms. Happy to provide references, and I don't get any kickbacks if someone sends me an email about that. But there are a couple of really good firms who are shockingly inexpensive and can help you with that. And in my experience, as most of you know, I spend most of my time with shareholder activism, even though I'm running also the public company practice at Sidley. And in my experience, 80% of the proxy fight every year in the United States are at companies with a market cap of under $1 billion, just because, in part, because they have not the bandwidth to focus so much on the investors. So when something goes sideways, there are no relationships, or at least no good relationships, that have been fostered for a long time. And these kind of situations tend to go sideways.
So I think both of you, those answers were really net helpful. And now there's sort of a different question, and maybe, we can just give this sort of a glancing blow, but thinking about the range of things that came out of 25 from the SEC, looking forward to what we know predictions are telling us, the additional kinds of positions they may be taking. What else beyond looking with your own advisors can you be doing? And one of the things that I remember from past board experiences under the Biden SEC and even previously, we routinely looked at other, 10K filings and proxies to see what our competitors were doing vis-a-vis lots of things from climate to human capital. And I'm sort of wondering, this question goes to, should companies be looking at their competitors to see what they're doing at proxy advisors and the changes they're making, and sort of, it feels like the answer is yes, but I don't have the color that you all might have to add to that.
Yeah, it's
Well,
a
I think the
resounding
answer
yes
is
as the response. Look, but it's a question of resources. Look, we have 1,000 public company clients at Settly, so we see the waterfront. You can ask us, and we can give you a very precise answers about, okay, what are your top five peers are doing on certain disclosure issues. For small cap companies who don't want to pay a Settly, look, EDGAR is available for everybody, and it requires some work, but I mean, this is information that's publicly available. It's always better to be in the middle of a pack than to stand out in any form or fashion. It's not a position that most of our clients want to be in.
That's exactly what our counsel always told us at Unum. It's the outside counsel would start every conversation. Don't be the early adopter. Don't be the last in line. Find that comfortable. That's the Goldilocks position. So would you add anything to that, Therese? Or
No, I think that's absolutely accurate. And I don't have anything to add.
So, Kai, one of the things I didn't ask, and I don't know how much detail we want to get into vis-a-vis BlackRock and Vanguard and State Street, but offering now these pass-through voting or voting choice programs and what the impact that may have and what companies should be looking for.
Yeah, so let's explain what we are talking about here,
Please.
Gloria, right? Which is, as you know, all asset managers have fiduciary duties to their own investors. This duty has been historically interpreted to a duty to vote the shares if they don't get instructions to the contrary. And what a number of large asset managers, including the ones you just referenced, have done in recent years is to basically go back to their own investors and say, look, give us instructions. I mean, we are going to vote the shares if you don't give us any instructions. But look, here's an easy way to do tell us how to vote. And that was at the outset a little nerve-wracking for company defense lawyers like me. Why? Because BlackRock, Vanguard, and State Street are the bodyguards of corporate America in a lot of proxy fights. They are the functional equivalent of Pennsylvania, Michigan, and Wisconsin in a lot of proxy fights when you go to a vote. And to see that vote now being diluted by through the pass-through voting system was a concern. However, what we have observed in recent years is that hardly anyone makes use of the pass-through voting option. And to the extent they do, they mostly vote with management anyway. So it was a huge concern. So far, it has not to materialize. And look, it's hard to argue with that, right? I mean, the ultimate investor should have a right to vote. It's just they're typically not interested. I mean, I don't know about you ladies, but I mean, I barely look at any of the voting materials that I get from my various investments. And I do this for a living. So most people care even less about it than I do.
No, guilty as charged. Teresa, I would love to now move into an area that I know you spent a lot of your time professionally and otherwise on, and that's governance issues. And start with, we talked about how much steam traditional mainstream governance issues have gotten in recent years, these traditional shareholder rights with investors. And one question that came up is what's going to happen with classified and declassified declassification of boards. It's a pretty mainstream thing, most of certainly the large cap companies, but what do you see as sort of the issue here, and who might they target, which I think is sort of an interesting aspect of it? Is it a toehold into if you have the wrong structure,
Mm-hmm.
and from an activist or an other perspective, isn't it a toehold in if you're not considering doing something about it to other things? Say if you're an underperforming company.
Right. Well, I did a little research on this, and it seems that classified or staggered boards, still exist in a number of markets, but they aren't seen generally as part of good corporate governance. And really, the argument against it is that if you are only putting by putting the board up, not putting the board up for reelection every year, it management can get more entrenched, and it makes it harder to replace underperforming directors and insulate board members from even the prospect of some sort of poor conduct. There are some asset managers that state in their voting policies that they will support the declassification of boards and oppose proposals to classify them. So I think that the best practice is to have annual elections to make sure that you have adequate review of your director's performance. And if you've got poor performance or performance that can be improved, you give either the lead director or the CEO is going to give those directors an opportunity to up their game, to be more participatory, whatever the issue happens to be. But one interesting fact was that resolutions seeking to declassify boards seem solid levels of support rather, from whether it comes from management or it comes from shareholders. So it seems that this still is the annual elections is probably still the best practice according to governance experts.
Well, I have to tell you from experience, looking back, it was basically when we were told you're not going to be Malcolm in the middle if you
Yeah,
don't do something about this. And that was
right.
some time ago, but it just depends on the company and their
It
own
does.
particular circumstances. But I think that was great detail. Kai, do you want
Right.
to add anything from an activist perspective or?
Yeah, I'll just offer up the not so popular opposing view, which is look, I mean, even with a classified board, you are up every 3 years. It's not like
Yeah,
you're not subject to any accountability. In my home country, Germany, by the way, it's every 5 years, just to give you
really.
some
Mm.
comparison. And look, just imagine if the President of the United States were up for election on an annual basis. We would be in civil war right now if
Yeah,
that
we
was the case. So, I
yeah.
mean, what I'm trying to say is, look, I understand the accountability piece, but we can also not overdo it. There are also shareholders at many companies have the right to call special meetings, to act by written consent. And if you are subject to a recall, if to use a political term, at all times, is this really going to incentivize boards and management teams to take risky steps that maybe in the short term not create shareholder value, but in the long term really make the company better and make this country much better? I mean, just imagine Steve Jobs' uh, foray into phones, right? I mean, it's these kind of innovations that I think we are risking if we overdo it a little bit with accountability. And purely from an activism and hostile takeover defense perspective, I will tell you that I tell all of my clients, I mean, hold on to your classified board with your
Hmm.
dying breath,
Hmm.
because it's virtually impossible to for a hostile bidder to take over the company. Then you adopt a poison pill to stop a tender offer, and then any hostile bidder needs to resort to two proxy fights to take over the company in successive years. That has never happened. That doesn't mean that a company cannot be taken over, but it makes it harder for an opportunistic bid to occur during a company's cycle when it's at the bottom of its valuation range in the public markets. And as it relates to activism, I mean, the classified board is a fantastic anti-activism device. Why? It's not because activists cannot run a control slate. Most of them don't. But they cannot pick and choose the directors they can go after. They need to pick the three that are up for election, to use an example. So as directors, I mean, I can tell you, I understand this is a prevailing view of what is best practice of corporate governance. I have a very different view. And if you're on a board of a company and you think about getting rid of your classified board, give me a call and let me explain to you why you should think about it.
You know, I think that's fabulous point counterpoint. And I do remember the debate. Now you're reminding me of the debate that was held when changes were made for various companies. I want to move on to something that, gosh, I think, got a great question about. It's become live in this proxy season, and that's what ExxonMobil is doing with their voluntary retail program. And Kai, I'm going to turn to you because I'd love to hear it. It's now out there. I checked, it's on their website. The companies can sign up to join the Merry Band. They got a green light from the SEC in September through their no action letter. And I'm just sort of wondering your thoughts about voluntary retail programs in general and what's happening with ExxonMobil and what kind of a model that sets now for a whole bunch of others. And maybe there are others in the field, but I feel like this is now gone live. So we're now talking about something that's real world.
Yeah, no, it's a very interesting topic, Gloria. And we talked earlier about many companies not wanting to be the first mover. Well, Exxon is not so reluctant, and kudos to them. So they negotiated with the SEC a program that is open only for retail investors, whereby retail investors can provide standing vote instructions to vote for management if they choose to. They get annual reminders. They can change their instruction at any time. They can change their vote at any time, all the way until the polls close. And there is a full disclosure of this program. So I thought that was innovative. There are some legal issues in how they set up the program. That's at least what some plaintiffs allege. So the company got sued in court over the program by a Florida pension fund. But this is America. That's why I left Germany and came to your great country. You love to litigate, which is great for lawyers and bad for everybody else, quite frankly. But hey, but putting the legal questions aside, the activist bar actually reacted pretty viciously and claimed this was a power grab. There was a very well publicized op-ed in the Wall Street Journal from the #1 law firm on the activist side, Olshan, someone I really respect, Andy Friedman, their chair, even though we don't always see eye to eye on the substance, but it's someone I respect and admire in all other ways, who really, really railed against this program. We countered, we published our own op-ed in the Wall Street Journal, and we were not paid by Exxon to do it, to be clear. We were not involved in this program. But I mean, for us, it is actually a solution to a significant problem that we have in the United States. And we touched on it when we talked about pass-through voting. It's the same issue, that there's the apathy of retail investors, most of whom don't vote. So even in proxy contests, statistically, about only 25 to 30% of the investors vote. So even if you inundate them with calls and emails and text messages, it's very rare for more than just 30% to vote, let alone at uncontested election where you don't get this level of outreach from the company. And look, most retail investors don't vote because they invested in the company because they trust management and gives them the benefit of a doubt. So I think it's perfectly fair to say, well, shouldn't retail investors have a chance to say, well, look, we invested in the company and I check the button here. I vote for management until and unless I change my mind. And the way Exxon set up the program also offers a distinction. You can either click vote for all, hell or high water, or vote for all except for proxy contest and certain change of control proxy votes on transactions, which is only fair, I think. Look, the goal here is to move the retail investors from the non-voter column into the voting population. And activists don't like that because, well, statistically, 80% of the time, sometimes over 90% of the time, when retail investors vote in proxy fights, they are supporting management, not the activists. So the activism industry has an interest in keeping the retail investors sedated on their couch, whereas the company, you actually want to turn out this crucial constituency, in particular, and this is important, if your company has significant retail. Now, a lot of companies have 95, 98% institutional investors. You don't care about this as much in those companies. But a number of our large and mega cap clients have 20, 30, sometimes 40% retail. Yeah, we are absolutely interested in that. And this is something that is very meaningful to those clients.
Thanks. Anyone want to add anything? That was an incredibly complete answer and enormously helpful because there are many who sort of haven't been keeping pace with the Wall Street Journal counterpoints. And so thank you. I thought that was terrific. And Charisse, I want to move to a bit more technical question, which is one that we're all familiar with. This puts a little bit of a spin on it. Most companies worry endlessly about having some sort of major adverse event. And in this case, the questioner asks about things like product recalls or mass tort events. And how do the directors given disclosure responsibilities, how do they avoid liability for securities fraud?
So obviously with directors, you have oversight over management, and it means that you're asking good questions of your management about what they are doing to communicate with the public. And the goal, first of all, this is going to be controlled by your general counsel and by your outside counsel, because you don't want to, in terms of educating the public, do anything that operates to be an admission against interest is going to be used against you in this. All of these people are going to be suing you if it's really some sort of mass event like this. So the goal really is trying to get a handle on the public discourse. And the board isn't going to have any responsibility. Once again, it's that you've got good management and you're taking good oversight over the management. The goal for the education of the public in general and public messaging is going to have to focus on efforts to cure whatever this harm is that's resulting from the adverse event. You can't really communicate directly to those people who are suffering the harm, those that are involved in the litigation. But once again, it's saying as much as you can, as much as your lawyers advise you, you can say to the public in terms of what kinds of mitigation you're taking. And also there has to be, from the board standpoint, part of your protection is making sure that there is a record of continuous interactions with senior management regarding the status of the investigation, the status of any corrective action, the status of, if you're in litigation, making attempts to settle this matter and move on, to fix it and to move on. Finally, I think that this is going to be one of these situations where there is going to be an extra burden on the board, because you can't just wait for a quarterly meeting. If this is a really serious impact and a serious damage to the brand of whatever your business happens to be, the board is going to be very busy, and you're going to have evidence, written evidence that you've had meetings, you've had briefings, and that you are taking this advisory role over management very seriously.
Oh, thank you. That was terrific. You and I were talking a little bit before with heavily regulated industry companies.
Yeah,
You're also busy disclosing exactly what the regulators require.
that's right. What the regulators,
And
right?
and
That's
that's
correct.
yet another, it's inappropriate, but it's a burden on the boards, again, to your point about oversight and what management
Yeah.
is doing and working with the general counsel and outside counsel. All of those things come together. No, I think that's a great response to that question. The next question really has to do, it's a little bit of what I'm thinking of as a college essay question, emerging in the growth of the exponential growth of AI and board, sort of whack-a-mole trying to maintain very effective oversight controls, both with respect to the AI strategy at one end, your value creation part, and then the other end, what are the governance structures that, sort of allow you to build trust? And this is really a great question. I'm going to read it. How are investors distinguishing between AI strategy and AI governance, and what proxy disclosure builds trust with investors, companies' oversight model, their risk controls, use cases, accountability? Is it all of the above or something else? And Kai, maybe I'll start with you, and maybe each of you could offer something crisp to sort of get us, what's here. No one expects the board or the company to be prognosticators about the future, but we know where we are now and sort of what are those guardrails at either end of that spectrum.
Yeah, as to cite a phrase that you have heard before, predictions are really problematic, in particular as they relate to the future. And look, the legal standard for the board in most jurisdictions is not to be perfect forecasters. We would all be billionaires if we were that. It's to make the best of the limited information that we have. That's the daily challenge as a board member and as an advisor giving advice to those directors, is you look at what you know, and you're trying to fulfill your fiduciary duties by first of all, by informing yourself as much as you can. That's your fiduciary duty of care, to make informed decisions. You can rely on advisors like me and Connie and others, and you can ask as many questions as you like. In most jurisdictions, you have an almost unfettered right for information as a director. But at the end of the day, you're never going to have perfect information. That's just not how the world rolls. And then you have to just need to put, and this is a duty of loyalty, you need to put your own interest aside for now, and need to put the best interest of the company on the top of your considerations. And what Delaware courts have been very clear about, and courts in other jurisdictions in this great country too, is that you can plan for the long term, meaning you can decide, okay, this may be not beneficial for the company in the short term, but in the long term, it pans out. And look, this is your North Star with all of these questions. You just go back to your basic fiduciary duties, and courts are not going to second guess it, your decision. That's what the business judgment rule is all about. Courts will defer to the business judgment of boards and not going to play 2020 hindsight in a courtroom if you got it wrong, right? Otherwise, we wouldn't have any innovation in this country, right? You need to take risks based on limited information all the time, right? I mean, I'm sure once someone started the internet, there were a lot of skeptics. I sometimes look back at some of the predictions that were made at the time, and those entrepreneurs who took the risk now look like geniuses. But at the time, it was a risky bet. And this is exactly what the corporate governance system and the laws in the United States are designed to incentivize.
And at the same time, I think you can also anticipate that investors are going to be antsy about all of this. All you have to do is look at the headlines of the last week. The AI bubble. Maybe it's growing faster vis-a-vis employment. than people anticipated. Look at the software debacle this week and that sell off of those stocks, given AI's capacity building, and the other kinds of things, AI security, the kinds of things we were talking about, cybersecurity, a decade or so ago, now brought to AI. So it's understandable that they're going to want to understand both what you're doing for the value creation, what you were just talking about, as well as how are you. I like your description of the basic Delaware set of responsibilities around risk controls and the kinds of things that you would be doing for anything, your accountability as a board member. So that's good. Would you add anything to that, Therese?
Yeah, the only thing I would add is I can remember 10 years ago when all of the corporate boards were looking at whether or not they wanted to have a cybersecurity expert on their board. And now in my boardrooms, we are all talking about AI. And so I think that in only one of my boards did we bring on someone who had cybersecurity. But there is great fear and trepidation with regard to the swiftness with which the change is occurring in the AI world. So I think that in line with the business judgment rule, what boards have to do is figure out who they need on the board. I mean, do we need that expertise, or can you hire it from a consultant? And that is one of the things that I know that corporate boards are discussing that now. The other issue is whether or not you want a senior executive in your management, whether or not you're giving your management advice about having a senior executive reporting to that CEO around these AI issues. So I think that these are just, I mean, we are advisors, and the boards have to be concerned. And I don't think there's one right answer. It could be that it's a senior executive. It could be that you want to have somebody on your board who has that expertise. But our boards and their advisory role need to be considering that.
Therese, that's exactly the result we saw when we did a survey. NACD New England, the chapter did a recent this fall survey of members of boards of directors, and they said overwhelmingly, I think it was over 60%, said something along the lines of, yeah, we're looking over the next year or so at adding that expertise. And it's still an open question as to, because of the rate of speed you described, maybe it is a little different than cybersecurity. And really, companies decided back in that time, and I remember those conversations too. Some went one way and some went the other way. But this is going to be an interesting one to draw a plot line with going forward. So I do want to move, and Connie, maybe I'll start with an AI related comp question for you before we go into some other executive comp questions that came up from our audience. And that's that just some reading I've been doing suggests that there really is growing interest in AI executive compensation, and sort of having comp committees really start to address, sort of now that additional conundrum that's being presented to boards.
Yes. That's a great segue into that. And I did want to add, I mean, there's got to be that open dialogue too between management and board members on that role of AI, what they need, how that's going to impact their people, and all of those things. It trickles down, from executives all the way through the organization. And so to your question on AI leaders, this has definitely been a conversation that we've had in many of our comp committee meetings. Kind of piggybacking on Therese's comment on technology and cybersecurity being a hot role, we saw CTO jobs being very much needed, and pay increasing to capture those leaders in that space. And now we're seeing that with AI, a premium needed to be paying these top executives in that space. And it's really driven, the tech companies can pay a lot of money for this. But some of the smaller ones, or even some large companies that don't have the resources that some of these large tech companies have, are really struggling on trying to pull those AI leaders into their firms, because it is something that's needed. Some of these companies that are non-tech are lagging, or they have tech businesses that they need some of these leaders for. So that's definitely something that we have been talking about. We've seen magnitude of pay go up. We've seen one-time awards for these leaders go up as well. And then on just the impact through the organization, we actually had just one company talk about how they were, this was at the compensation committee meeting, talk about how they were trying to understand the skills of their employees because AI will take away some of these jobs. They don't want to lay everyone off, but if there are ways to redeploy them within the organization because they are high performers, they are valued, those are things that they're looking at now. And so I think if companies have not started doing that, that's also something very important. You already have these great employees within your firm. Where can we put them to continue to grow and evolve as a company?
That's a really great additional point. We did get one terrific, I thought, question in chat from our last session about heightened shareholder scrutiny this proxy season and how executive comp is going to just remain, as you well know more better than anyone on this panel, about the contentiousness of the issue across many issues. And this questioner asked specifically about additional scrutiny for executive comp and obviously pay for performance alignment when it's always a matter of each comp committee grappling with it. One-time awards, referring to that just a second ago, the rigor of goal setting, the kinds of things that sort of raise the eyebrows of investors who care about comp issues and may want to dig deeper in what that's doing to an already probably overworked comp committee at the board level.
Yeah. This is part of the information overload. Also with AI, we get a lot more information. We could type into ChatGPT or Copilot,
Yep.
please answer this for me. Tell me some examples, things like that. So yes, pay for performance, as y'all know, is really the key driver to a lot of these recommendations for proxy advisors, for institutional investors. So that's the main thing. Do we have aligned pay for performance? Proxy advisors look at that. And then if you do, they'll still look at qualitative factors, but any one thing that might be off market might not necessarily push you over into a against recommendation. But if you do not have pay for performance, there will be a deep dive into some of these qualitative factors related to your pay program structure and design. And so, last year and actually in the last couple years, right, these large one-time awards, inappropriate severance packages. And what I mean by that is really if you provide any payment or benefits that are beyond what was in the contract or what the contractual obligations were, these were targeted. So even companies that had pay for performance alignment, if you had one of these items, it could trigger an against recommendation from proxy advisors. And nobody wants that, even though, most companies do get major shareholder support on their executive pay. Going into 2026, we talked about this on our last session where ISS and Glass Lewis have kind of overhauled, in a way, their pay for performance methodology. And what I mean by that, they've extended it from 3 years to 5 years. So with one-time awards, these pay decisions, they might be muted over a 5-year period when you're looking at 5 whole years, but they'll also stay in those analyses because they're now over a 5-year period. So any one decision you make in 1 year could have, that will be seen throughout at least the numbers for the next 5 years. But on one-time awards, we've seen a lot of it. We've helped companies with a lot of it, designing some of these awards. And the number one thing is it needs to be performance-based. But we also have heard from clients and their investors saying, we expect the annual pay program to really be well-structured and motivating for executives. So any one-time awards, they're viewed as Glass Lewis would say, undermining the integrity of your regular annual program. So there is that balance there on how to navigate those one-time awards. In addition, goal setting, annual or long-term goals that are set below your prior year targets or actual results without a compelling reason, those will also draw potential concern. And then we've also seen with clients who have an elevated concern on their pay for performance, companies will look at their PSU programs. That is the largest part of many executives' pay package. And so they'll look at how you set goals there. TSR goal setting, that's been commented on. Many don't find that 50th percentile is necessarily rigorous for a target payout. The structure of your PSU plans is important to consider as well if you have atypically high payout opportunities. So I know a lot of companies, we show target in our proxy disclosure, but we also have a maximum. And that's kind of been under the radar in a way, but most companies have 200%. So if you have something like 350%, 400%, and pay for performance misalignment, that might draw some scrutiny there. And then, of course, any overly complex programs that are hard to understand, there could be a comment there because they don't understand what's going on. And then the lack of forward disclosure. So all of those things could be additional focal points if you do have pay for performance misalignment. And then I just wanted to highlight one more item. ISS did clarify their view on heavily discretionary bonuses. So that's something to also consider. Most companies have a plan in place and have a rigorous way that they go through, metric weightings and things like that. But both ISS and Glass Lewis have noted if you have a fully discretionary bonus program or make adjustments that don't have compelling rationale for those adjustments, those will also draw scrutiny.
So I think all those points that you just gave are excellent tips, advice for comp committees and full boards, and of course the management team consideration. And it really is additive to the things that you talked about in our first session. So we have two more two more categories that I want to cover, and I need to ask a question. I'm in favor of adding a little bit of time to this. I don't see any reason why we couldn't, as long as your own calendar permits us to add a little bit of extra time for our conversation. Does that work for everybody?
Yes,
I'm
a little bit.
I'm running a little bit against the wall soon. So
okay, we'll do our best here. What I want to do is consolidate a little bit our conversation around ESG and move it from just DEI. Shouldn't say just DEI. It's incredibly relevant for so many reasons, employees wide, and obviously diversity on the board level, but tie it to ESG more broadly too. And we had two questions. One's really in the form of comments that really does ask about developing a diverse workforce. In one case that ties to driving innovation in the company. And the second set of comments really talks about recognizing the evolving nature of your workforce in terms of diversity as it matches your customer base. And both of those, from my perspective, seem to be both areas they're driving at. The questions are driving at how do you make this, both of these material in terms of with diversity, growing diversity material in terms of your business case, your long-term enterprise valuation value goals. So I'll start with you, Therese. You did a great job. You and Connie both discussed this pretty extensively in our first conversation. I think this has something to do in the current environment too, obviously hostile environment around this even type of conversation, but how it also relates to how you're communicating, because I'll tie it to some data that I saw when I was thinking about this session that says most public companies are staying the course on whatever DEI and broader diversity and climate and environment goals that they were doing. But in many cases, they've chosen to go silent about it. They're not doing sustainability reports, or they're really cutting back in terms of how they communicate. And so it strikes me that that's a real conundrum, given the nature of the investor shareholder with company inability of the big investors to also exchange views on topics readily. So how do you thread this needle, the Goldilocks model for doing what you believe is right for your business now and going forward, as well as communicating it effectively?
Right. Well, I think that there has to be honest communication And it is possible, and this also gets to your senior leadership in terms of your communications people. But any good strategy is going to have to focus on the demographics of both your customer base and the employee base. And I think it is true that if the CEO and senior management are concerned about the values which are important to running their successful business, and they're being successful, it is not necessary for you to be loud about it. You just do the work. You do that work. And in terms of both environmental as well as the human capital goals, I think leadership should just do the work and don't pick a fight, and don't, I just think you can put your head down, do this work, and there's still going to be there are going to be companies that are putting their head down and not trumpeting, who are going to be picked on. So I think that a company and through its CEO and the board oversight has to decide what their values are. And there is going to be some risk if you continue to do that work. There is going to be some risk, but I think it's worth doing that. And you can also hopefully survive whatever the political consequences of elections might be over the long run. I think you just have to have a very long view rather than going completely negative on what your values are and the business strategy that you have developed in order to run that company and make it successful.
Do you think there are some effective ways to figure out how you strike that communication model? I can understand some of not using the terminology, maybe ESG on your report, reframing it in other ways.
Right.
But given the difficulty in sharing the information now with your investors, how do you sort of strike that chord while you continue to stay the course, do the work?
Right. Well, I think that you can communicate this without having the videos and the splashy handouts that you might have done in the past. And I do think that some of this will pass. And in the meantime, it is a question of how you communicate that information. But obviously, you've got to be open and honest with the information that you're giving to your investors.
So, Connie, would you add anything to that?
I mean, sticking to your core principles, right? That's what's important. The pendulum can swing the other way. We were in that, a few years ago, and we had a client. They very much valued diversity and all of the DEI elements. They didn't think they had to include it in their compensation program for incentivizing executives because this was part of their DNA. And at that time, there was a push to include some DEI metrics and incentives. And so they had an open conversation and discussion about that and decided not to, but they stuck to their core principles. And that communication was important throughout the entire organization. They emphasized that. And now in this environment, they are still emphasizing that, even though the pendulum swung the other way. So, coming to say there's a lot of things that are going on. And you want to know what your peers are doing all the time. At that time, we were looking at how many companies were adding in ESG metrics to their annual incentive programs, their long-term incentive programs. How are they measuring it? Things like that. So you definitely want to be aware of that. But like with any sort of design changes with compensation, what's your compensation philosophy? What are your core principles and how are we sticking to that? As it relates to comp, is this a value driver for the company, right? And it can be, but it doesn't always have to make it into the compensation program. So
how much of this do you think is really now core? Obviously, senior management team, obviously driven across the company, top down, bottom up, but your board responsibility, because it used to be in prior times, prior to the backlash, that you were pretty much working in concert with your top investors who were carrying the torch appropriately for these issues. Climate, definitely, but also equally human capital management, as was the SEC. So talk a little bit about, and this relates to the last question that we received on this in this area, which was very interesting conversation. Be interesting to follow up on the role of leadership in ESG governance as it impacts investor decision making. And that's a little bit of what I was trying to get to with respect to more difficult to now share what you're doing with your investors unless you are getting in front of them, and putting it in your proxy in a way that is appropriate for the times, and lets you get your points across. But also, what is the board sort of leadership? It feels like there's an even bigger board leadership role at this point vis-a-vis ESG in terms of thinking about its importance, because you're not going to have the major investors able to sort of communicate at the same level they were in the past.
Well, I do think it's incumbent on directors if it's important to them. I mean, this is the other thing. If you've got directors that were brought onto that board because of the vision that you had senior leadership expressing, you are going to have board members in that boardroom that are going to be saying these are things that are important. They're important to our constituencies. They're important to our customers. It's important that we measure these things. You don't have to throw a bright light on the way that you're measuring them, but it's incumbent on board members who are in line with those values to have that conversation in the boardroom.
You know, I was taken by your comment about, splashy show and tell documents, that kind of thing.
Right.
In some cases, I always found those suspect that was more performative than actual performance. Right. So what you're both talking about really demonstrates the stay the course, but understand that you're operating in a somewhat different environment. Kai, I swore that we would get some activism trends in 2026 because you were able to a bit to get to the sort of the initial thrust in our last conversation, but I'd love you to talk a little bit about M&A in 26. I know there's lots going on, and the kinds of things that, activism things that maybe you didn't draw a circle around last time that you would point out, and maybe where they are going to attract institutional investor support.
Yeah,
but start with M&A.
Yeah. M&A is alive and well. We had an extraordinarily busy year last year for M&A, which quite frankly surprised me because we all remember very vividly the market turmoil following the beginning of the trade wars by the Trump administration with Liberation Day as a culmination. But the M&A markets recovered relatively quickly. And I think what is driving M&A right now is the widely held sentiment that it's now or never. We might never get a more antitrust-friendly administration in the foreseeable future. Share prices seem to go up. And there is a little bit of a widespread feeling that you might miss out if you don't pursue now the M&A you've wanted to do for a long time. Which is why we also see a significant rise of unsolicited and hostile takeover bids. I think in the last 12 months, I had 12 unsolicited takeover bids to defend, which is typically the number of matters that I have over half a decade. So there is an extraordinary rise of these approaches as well, and a lot of companies that receive an unsolicited bid receive not only one but several. I have a client of mine who received 3 unsolicited bids in relatively short order just this week. And so this is another interesting development. And how does activism play into all of this? Well, activists are all over M&A. Why? Because it's the easiest way to make a quick buck from an activist perspective, right? Just imagine company is trading at $10 a share. You buy a significant stake at that price. Then you harass the board of the target company until the board says, life's too short for this. Let's just sell the company. You sell the company at $15, and then the activist walks away with a $5 spread, a 50% profit. That is before leverage. that's a significant pot of gold right there. So that's activism for you in a nutshell in small and mid-cap land. Now, when companies are bigger, it goes to more to break up activism. But sell the company activism is driving this or as well. And there is clearly there are synergies between hostile bidders and activists, right? Think about it. I mean, hostile bidders are looking to acquire a company that may not be willing to sell. Activists want companies sold. So there is a little bit of that unholy alliance. I should put unholy in quotation marks because when I represent hostile bidders, it's exactly what I do. I go out and see whether I can find an activist to put the company under pressure for me and my client. So that's just the way the game is played. But all of this has resulted in a really red hot M&A market right now, including mega sized deals, and and that in turn inspires activists, right? If there's a red hot M&A market, activists are making money left and right. So this is a spiral that feeds itself. And but interestingly, what we also see more and more is activism against M&A deals. What do I mean by that? There were a number of deals that were, at least from the activist perspective, poorly structured. The process was flawed. And then activists come to pound on you, either on the buy side, if you are overpaying, you run the risk that an activist is going to come after you for building an empire without financial discipline. But more so, you see activism in connection with M&A transactions on the target side, when there is a feeling that the target board didn't negotiate well, that the process was flawed, including with related interests and other conflict of interest issues. And the reality is there is no deal until and unless the shareholders vote for it. So what a lot of companies are doing not enough is they're so focused on negotiating the deal. And I've seen it many, many times before, like at 4 a.m., finally, you have the final agreement, you sign on the dotted line, the boards approve, everybody is popping champagne. And then in the middle of the third glass, you see an email in your inbox, oh, there's a press release. Can anyone take a quick look at the press release? And no one is really focused on the rollout. No one is focused on, okay, the deal is not done until the shareholders have approved it. You need to go out and explain this deal to the shareholders. And if you do a poor job of that, I mean, that deal might very well fall apart over deal opposition. And I think there are a number of really painful lessons learned by companies. I'm not going to name them because it includes clients that I was not involved with. But this is something that companies need to focus on. Signing on the dotted line of the merger agreement doesn't mean there's a done deal. You need to focus on the shareholder vote, and you get only one chance to roll out your deal properly. There are no second chances. If you screw up the rollout, it's kind of hard to repair the damage afterwards.
Well, once again, thank you. First of all, that was an excellent review in record time of a really complicated and expanding field of interest to everybody I know who will watch this program. But also, you're tying it together with your communication strategy, which we know that relates to almost everything we've talked about. If you're not have the right approach for a variety of reasons, someone else will be providing the disinformation that you hope to avoid. So thank you so much for that. Anything anyone else would add to the activism discussion? No. That was pitch perfect, as were all of your comments. I can't thank you enough. The one thing I would ask is if we could do an incredible lightning round you gave great takeaways in our last program, the first session, and in session 2. Is there anything you'd add as a takeaway, or do you want to reiterate something you said the first time? Connie, I'll start with you because you're first on my screen.
Sounds good. So I will say one of my favorite beer companies has a core guiding principle, and it's do what's right no matter what. And I've kind of used that as my mantra as well. But I think as your role on the board, that's something that's important to think about too as you navigate. There is a lot of noise. There's a lot what's going on. Do what's right for your role as your fiduciary duty on the board. Do what's right for the company and management and all stakeholders. So as you go through navigating, this upcoming proxy season, closing out year-end financials, if you're a calendar year-end company, that's just something I want to put out there. Do what's right no matter what.
That's terrific. Therese?
Yes, yes. A solid business strategy should include a clear articulation of the values which govern your business. This is first and foremost, of course, returning a solid economic return and growth to your shareholders while respecting and valuing your customers, your employees, and the community at large. Focus on succession planning for the C-suite and the board, and always be on the lookout for knowledgeable and savvy talent, and consider adding age diversity to the diverse viewpoints that you welcome into your boardroom.
Thank you, Therese. And Kai, I'm going to give you the last word. You started this conversation, you get to end it.
Okay, well, the advice that I heard is not limited to beer companies, but look, just have a couple of beers every once in a while. Keep calm and carry on. There is a lot going on in the world, but the world moves very, very fast. What is a scandal today is forgotten tomorrow. Don't act on every fad. Don't act on every perceived outrage. Just keep calm, and every once in a while, unless you're a teetotaler, have a drink and think about what you're doing. Don't rush to any decisions.
I may take your advice tonight, if not sooner. I can't thank you enough. I would be in a bunker under the worst circumstances with all three of you in any circumstance. And just again, this has been an incredibly great conversation, and also particularly additive to the first conversation we had. So I'm hopeful that our audience will get to view both. And I hope to see you all at a future program. Thank you again.
Thank you.
Thanks for having us.
Thank you.
Take good care.
Bye-bye.
Bye-bye.